Yes. There we go. We are on record. Okay, awesome. So, welcome along, everyone. Smaller crowd tonight. As I mentioned, there are a lot of us away. Um, but this is a subject which comes up. Graham, thank you. Thank you so much for joining us.
No
It's a
problem at
subject
all.
that comes up again and again and again and again. How do I use my pension? What's the best pension structure? And obviously, Graham, you'll be talking to a very sort of generic type of approach because obviously this is not personal financial advice. So yeah, just for clarity to anyone who doesn't know, we have Graham along from Sale International, who is our recommended accounting partner and tax advisory partner, and he will be talking about SIPP and SASS, or pensions in general, and I suppose focusing on SIPP and SASS. And Graham, is that right? You'll be talking about sort of the approach that we use, how we utilize these different entities in the property investing world.
Yes, that's correct, Justin. I'll just be going briefly or going into what they are and then discussing how they can be used in different ways and the key considerations to look out and how you can benefit in property investment while using those pensions.
Amazing. Thank you so much. Okay, so look, no need to hear my voice for too long. Over to you. What we'll do is, anyone's got any questions, please just drop them in the chat, either private to me or just the general chat, and then we'll pick those up as soon as Graham has finished. So, Graham, over to you. Thank you so much once again, and over to you.
Perfect. Thank you very much, Justin. Thank you for having us on today. I'll just share my screen quickly and then we can get going. Let me know if you do so. There we go.
Perfect.
Perfect.
There we go. Thanks.
Perfect. So once again, thanks for having us on today as Sale International. We're just going to give you an overview of using SASS and SIPP pensions in investments and in property investment strategies in particular for this. And so as Justin said, it's more just general advice because we are not financial planners or financial advisors, but we advise on the tax side of things. What can be done from a tax planning perspective, what the implications be, and how can that be used to benefit you. So just in that general sense, it's just a general disclaimer on that it's not any specific advice relating to your own case, it's all general advice. But once again, we always suggest a meeting or further consultation if there are specifics that you'd like to discuss. So for those who don't know us as Sale International, we've been around since 2002 and we're a group of professional tax and commercial advisors. We specialize in the cross-border tax matters, but as well as our main bases being in South Africa and the UK. So we specialize in UK investments, or tax planning wise, property investments, accounting for that side of it as well, doing the books and so on. So that is our areas. And then, as we said, we'll be speaking about SIPPs and SASS pensions today. So first of all, just generally, what is a SIPP? So a SIPP is a self-invested personal pension. It's managed generally by a regulated provider. So it's someone you go through to do it, but that means that they are the provider and in charge of the funds, but you can still choose what type of investment you want to make in it. So therefore, if you are wanting to invest in commercial property, you can still get that through a SIPP to do that. And I'll get into the details on what that means and how it works. But then also you can obviously invest in shares and funds and ETFs and bonds as well. And it's, as I said, personal investment control without the admin burden of where SASS has come in, which is more of a trust-based investment. And it's called, the full name is a small self-administrated scheme. And it's generally for the directors and key employees in a company, and it can have up to 11 members. The trustees, who are generally the members or directors in that company, control the investments and the compliance. So it's not a regulated person like it is with the SIPP, but those are then managed by yourself, and you can then use them in your business depending on the regulations. So the key there is you can loan up to 50% of the fund value to the employer, so the person who has set up the fund, and that can be used for basically any business purpose. And then the business owners if they're wanting to invest pensions into their business or property project, it's more specialized for that and helps as it gives a bit of a broader range than a SIPP. So first of all, before you just put all your money into it or go into it, they are important to know what the contribution limits are so that these can be applied each year. So this is generally, you're allowed £60,000 a year into a SIPP or a SASS, or 100% of your relevant earnings if your earnings are lower than £60,000. So relative earnings is salary, rental income, and that. So if your earnings are only 30,000 a year, you can only contribute 30,000 to a SIPP per year, and then the limit is 60,000. So if you're earning above that, you can't contribute more. And then with that, you can use your unused allowances for the past 3 years, unused portion. So if you didn't contribute at all, you generally can't use that year. But if you were contributing 10,000 a year for the last 3 years, you have 50,000 each year to use plus your current year. So that would take you to 210,000 for the current year to be able to use in 1 year. With saying that, though, the contribution limits did change. For 23-24 tax year and earlier, it was £40,000 a year. Sorry, 22-23 was 40,000, 23-24 is 60,000. So yeah, there's that slight difference there. But that's how it would work. That's how you limit. And then if you're making those contributions directly from the company, those pensions or those contributions are a tax deductible expense in the company. So it's also a pre-tax expense, so it reduces your corporate profits. So it's quite a nice way of getting funds into a pension, which then can basically be reused in the business in certain ways, as well as reducing your corporate tax. So now let's look at what that means in terms of investing using a SIPP or a SASS in specifically commercial property. So firstly, it's important to note that there are heavy penalties that can be up to 55% when it comes to investing in a residential property investment, unless it is just incidental. So for example, if you buy a storefront and there's a flat above it, that would then be seen as incidental, but it can't be the main function being the rental side of it. So it's got to be the commercial side of things, offices, warehouses, factories, that side of property. You're then able to use your SIPP and SASS funds to do that. And on that lines can be done through both. So firstly, it can, well, if you're looking at both of them, you can borrow up to 50% of the net asset value of the fund to purchase a qualifying asset, which is generally a commercial property. And then further on from that, if it's a SASS, only applying to SASS, you can lend up to 50% of the funds to the employer. So that's, you can pull it out as a loan essentially. And then if it's a loan, it must still be secured with legal assets and that attached to it, repaid within 5 years with commercial interest rates and equal annual installments. But it does give you the chance to take that money out, use it in the company, and then those expenses such as interest is obviously a tax deductible expense in the company. And so those are how you would kind of invest between the two of them. So you both can borrow or take out 50% of the value to use to purchase a property, but only through a SASS can you lend money out to use any business investments. So that's buying equipment or things other than just property. So then if we go look at the tax benefits of it and what it means for when you do retire or want to take funds out in the future. First of all, anything that you then generate and goes into that pension is generally tax-free. So for example, you buy now a commercial property through your pension, that rental income that you get from your own company being, let's say you own an office and you run a company in that office, that the pension buys a commercial property and then it rents, and then your business rents it from the pension. That rent that you charge is tax-free income in your pension. So it grows your pension tax-free, as well as in the capital gains on the disposal of that property at any time in the future would also be tax-free in the pension. And then, as I mentioned previously, those pension contributions in the company to that SASS or SIPP is deductible in the business. And then you get a 25% tax-free lump sum on withdrawal from that pension, subject to the lifetime limit. And then you still get inheritance tax advantages of that as well, because generally pensions are excluded from inheritance tax. So following that, we're just going to look into a case study of it, just talking about the two options regarding whether to use a SIPP or a SASS and what the difference would be. So we just have a client here who is wanting to move into a larger office and possibly wanting to use their pension funds to support a new property purchase. So they currently have an existing SIPP of £300,000. So there's two scenarios on doing this. So one is you can stay in your SIPP, and what that would mean is you would sell that existing SIPP, if it's investment shares or bonds, into cash in the SIPP. So you have that as available funds within your SIPP. Then the SIPP identifies a warehouse or an office that it would like to use to purchase, and now it can purchase up to 150,000 additional value. So therefore, it identifies a 450,000 warehouse, borrows, the 150,000 from the bank, because the max allowed is a 50%, of the net asset. So it buys this property directly. The SIPP provider is then the legal owner. And then the company rents the building, your company, from that SIPP at a market-related rent. Now, the financial outcome on that would be, the rent is 36,000 a year, or whatever the rental amount is per month, is paid by the company to the SIPP. There's no CGT on the property if later sold, and the company deducts that rent as a business expense for corporation tax. And then you can't take money out of the pension to use for other business purposes. So it only can be used to purchase that bigger office or that commercial property that you're looking at. Now, if we change it and we look at what the advantages would be of a SASS. So firstly, you can transfer a SIPP to a SASS if you want. So that is an option if you have a large SIPP and you want to then use it to assist with property investments. So that's the first step. You first will set up SASS registered with HMRC, and then you transfer the £300,000 from the SIPP to the SASS. Now, the SASS can make a loan back to the company of 50% of the value, so £150,000 in this case. And then the company uses £150,000 loan to make a deposit on another commercial property of, in this case, £400,000, and they mortgage the rest. And then £50,000 of that loan was then used to upgrade equipment and whatever they needed to run their business. So it can be used on both sides of it. As you see, that's the additional advantage. And then the remaining £150,000 stays invested in commercial property. So therefore, it's also providing different investments. One, you're invested directly in the property, and then partially you in the company and the investment through that loan itself. So then for that, the outcome is you now, as your SIPP, your SASS, earns loan interest. In this case, it's £9,000 per year, paid by the company to the SASS tax-free inside the pension. The capital repayments rebuild the pension over 5 years. So it's not a long-term event, but you do then get the funds back as well as that interest benefit or additional funds in it. And then the company deducts interest as a business expense. So on one side, you're gaining value. On the other side, it's an expense, but it's also not increasing your tax liability. So it does help you as a whole. And as I said, then it's partially invested in property directly and partially through the company in terms of a loan. So this basically covers a brief overview of how they can be used and structured to set up and help yourself. But it's always important to kind of check your limits if you are doing this to make sure your contributions are within the limits. If you are wanting to set it up so you have a larger SIPP or SASS fund to be able to make the loan or do the borrow against the net asset value. And then once that is, make sure those are done correctly and then the correct terms are done and the property you're investing in is commercial property, so it doesn't fall foul of any of the penalties that would come in. So in this regard, how can we as SAIL help? We assess your situation and advise on it. We offer a free consultation where we arrange a meeting, you give us your side of the story, what your situation is, what you're looking for. We can then assess it and advise on what needs to be done and how best to structure it. And this is not just from a pension side of things, but on a tax side of things regarding your properties and what investments you want to do, or just as yourself as resident, if you are a resident in the UK or not, we can advise in those areas as well. And then also you can sign up to our social media and mailers if you do want to stay in touch and see weekly tax or monthly tax tips in that regard. And then here's just our contact details and a QR code, which you can scan to my meeting link if you do want to book a call. But that basically covers it from our end. So thank you for joining us today. And then I'll hand it back over to Justin for questions.
Awesome. Thank you so much. Okay, nice, good overview. So I got a couple of questions that were sent in from people that are on holiday, which apparently is the whole world at the moment. But yeah, thanks again, Graham. That was a good overview. So the first question I had, actually, I'm going to leave that until last because that's a bit more. I know the circumstances of that question, so I need to flesh it out a bit. So just to clarify there, you can have a SIPP and a SASS and do loans between the two of them to enable purchases of property. Is that right?
So yes, you can have both, but it's not a loan between the two of them. You can transfer between the two of them because they're both registered funds. So you're not loaning from one to the other, it's just transferring the funds from one to the other, but there's no income tax charges on those transfers between those two funds because as long as they're registered funds and the transfer is done correctly, so you follow the correct channels and there's no problem on doing that.
Okay, perfect. And then, so just thinking this through in terms of, I understand the commercial property. We've actually got a scenario where we're trying to convince the trustees of a SIPP that what we do is commercial, but I think we're in that grey area where it's probably not. But that's probably quite a niche problem. But let's say you wanted to buy a residential property. Now, obviously, you can't do that through your SIPP. But could you lend money from the SIPP to the SASS to then lend it to your property company to then purchase residential real estate?
The limits are somewhat the same because that SASS is still limited to commercial activities. Okay. So it's got to be tied in with that business. So it comes down to being able to argue it that is that a commercial property or your business, because you don't have to necessarily buy property. You can use it to fund the business. So if you're using it to fund the business, you probably could get it through that way. But you would just have to be very careful on how you do it and make sure it's well explained and fleshed out so that you don't have problems.
And who makes that decision? The trustees?
Yes.
Okay. Perfect. Okay. All right, so that covers that. Yep, that makes sense. And then you said the SIPP can be backdated in terms of the contribution. So I know just from my own world, a lot of people that earn sort of 100K plus, they will often pay sort of just over 100.
Yes.
Will often pay into a pension of some description to reduce their tax liability.
Yes.
Now, and that's a perfectly legal and common thing. So my question is, what does that scenario look like? I'm just thinking, when I ask these questions, I've got particular clients in mind. Obviously, I'm not going to say who they are, but I mean, what does that look like in terms of your tax liability if you back pay the maximum you're allowed into either your SIPP or your SASS if you are earning over 100K? Is that a feasible scenario?
Yes, so that's why I mentioned the limits, because if you go over those limits, you pay basically a penalty or higher charge. It's in whatever. So if your limit's 60,000, you contribute 70,000. That extra 10,000 is added to your income and it's taxed as income, which essentially is not what you want. So the advantage of doing it is why a lot of people do it that are just over that 100,000 bracket is because of the personal allowance. Because you increase your bracket so you can still get your full personal allowance. So if you're earning, if you have a salary of 200,000 in a year and you have unused contributions from the previous years, you could contribute essentially 100,000 in 1 year, get your full personal allowance, also be taxed at 40% on a lot of your income rather than at 45%. So you save a bit there, and then it goes into that pension, which you can then use if you do have a business which is kind of operating through it. So that's a good advantage. And then the other way that a lot of people do is, as I mentioned, you can invest it instead of taking that. If you have your own company, instead of taking the money out of the company, having to pay tax on it as a dividend or a salary, and then investing it into your own SIPP or SASS from there, you invest it or you contribute it directly to that SIPP or SASS from the company. So that company contribution means it's not done personally; it's done through the company. So the company, that is an expense in the company. So it reduces your taxable profits for the year to a lower amount. So you could possibly make use of the 90% tax bracket or have no tax to pay for that year, depending on what your profits are.
Yeah.
And then also, if you've kind of stockpiled reserves in the company because you've been taking out bits of money every year because you don't want to go into a higher tax bracket or start losing your personal allowance, you could have a high level of reserves, which then means you could take out part of that reserves and contribute it directly to a SIPP or SASS from there. And that way you're getting the money out of the company to be able to use in other, reinvest it into other things, essentially.
Fair. Okay, perfect. Then the other question, the one that I want to sort of hold off on, and just a heads up, Gareth Hume, I'm going to ask you a question about lending in a second, because it'd be interesting to know how this relates to lending. But before that, I want to get to the question that I was asked, and that's about immigration. So it was sent to me via WhatsApp, literally, what happens if we immigrate? Now, I know the person's situation, so let me flesh that out a little bit.
Sounds great.
So the thought process there is he may be able to get a what you might call it, a transfer, sequestration, or whatever it's called, to the UAE, to Dubai, which is where so many people seem to be going. But he can legitimately get a transfer, UK national, no dual citizenship, and he is looking to go to Dubai, work there for 5 years, and he would want to know what happens. He already has an existing SASS. I'll stand corrected, but I'm pretty confident it's a SASS. The question he really asks is, can he still contribute? Does he lose? Does he bear any penalties for that? And I suppose the secondary question that I would then ask is, what if somebody, was moving to another country sort of longer term, or holds a second, much like myself, holds dual citizenship of another country, and for example, just to use myself as an example, if I wanted to move to South Africa for an extended amount of time, what would that look like? So let's deal with the first scenario first. What happens if you citizen no longer resident, and secondly, if I suppose it's almost the same question, but yeah, I'll let you go ahead.
Perfect. Yeah. So from the tax rate, it's always important to separate, citizenship and residence and tax residency, because it's judged differently. And in the UK, you can cease tax residency relatively easy. You just have to notify HMRC either by basically a form or in your self-assessment at the end of the year. But essentially, by doing that, you can still have your SIPPs and your SASSs and continue contributing to them, or keep the funds in them. It's not like your tax-free savings accounts where you then are limited because you're not a tax resident. So you can still have a foreign pension as or be a foreigner and have a pension in the UK. And so that's not a problem, or private pensions. So he can continue to do that. And then as a non-resident, because it is from, if let's say down the line he starts earning income from that pension or gets paid out, monthly, or takes out a lump sum, that would then, you'd have to look at the double tax agreement to see who would have taxing rights on that pension at that point. So as you mentioned, like South Africa, I know with their double tax agreement, it says the pension is only taxable in the country in which you are tax resident. So for example, if you've ceased UK tax residents, you're only tax resident in South Africa, they have taxing rights, even though you've put it in the UK and it's been invested there and everything, the UK lose the right to do that. So I'm not 100% sure off the top of my head what the condition is in the double tax agreement between the UK and the UAE, but you would look at that to see how it would be taxed. And then essentially all the income also would follow that way. So as a non-resident in the UK, only income from UK sources is taxable in the UK, and anything else would be exempt from tax in the UK. And then your other things you'd look at long term is that the capital gains tax side of things, because the UK has a clause, you can't leave for a year, just dispose of all your foreign assets, come back to the UK, and then get out of the capital gains tax net. There has to be at least 5 years non-residency. And then with the changes of inheritance tax as well, there's ways that if you aren't resident for a certain amount of time, you don't fall in that tax net immediately. And if you're out of the country for 10 years, once you return, you're seen as a new resident again. So then you get a 4-year foreign income and gains regime. So there are options that can be used for people moving around the country, short term and long term. So that's where suggest a consult and advise kind of based on what it is for their situation, because there's different options.
Yeah, and that's before they change it all in about a
Yes,
couple of years,
before
likely.
before the non-dom regimes get removed because everyone hates
Exactly,
them so much.
exactly. Yeah, I'm so glad I don't. In no disrespect, I'm glad you are part of the team, but I'm so glad I don't have to keep up with that regulation. My goodness.
Fair enough. I don't
Anyway,
blame you.
so sorry, anybody that has joined, please do ask any questions. Just ask in the chat or message me directly if it's a more personal question. And I'll keep it private, and I will ask Graham. Gareth, are you there? Let's see if he's there. Oh, there you go.
Yes, I'm here.
Hi, Gareth. So
Yeah.
I just want something just occurred to me whilst we're going through it. So obviously, great sort of overview from Graham there. But what happens in terms of lending? So you've borrowed money or lent money, I don't know what the right term is, from one of your pensions into a property investing company. What happens from a lending perspective? Do lenders, are they okay with it? Or, does it?
So just the honest truth is yes and no.
Okay.
Okay, that's the honest truth. Is a lot of lenders don't like SIPPs and SASSs, um, and for a number of reasons, because of the complexity behind it, uh, and a lot of the stuff comes down to just the understanding of underwriters.
Mm,
Uh, and that's the thing is, to a lot of banks, computer says no.
mm,
And to try educate banks on different strategies takes a little bit of time, as we've seen in the social housing kind of scheme and that. Okay. But there are specialist lenders now that are looking into new things, because the specialist buy-to-let lenders rely on portfolio landlords. Now, the average portfolio landlord the average landlord in the UK, as you know, has 8 properties. And a lot of people are moving into the commercial space now, because of where the returns are. So there are lenders in there, but bearing in mind that commercial property as a whole and is the rates are more expensive than on a buy to let.
yeah.
So we're on a buy to let rate, some lenders you can get TFX with huge product fees in the 3%. On the commercial spaces, you're generally looking in the 6, 7, even in some cases 8% ranges. But the yield, but that's you're getting 10, 15-year leases on there, and
Yeah.
it is slightly different. But that said, also lenders generally on the commercial space like experience. So my recommendation for anyone that's looking to go down this route is it's good to have a normal buy to let to tick the experience. It's a different kettle of fish, a commercial proposition versus a normal residential proposition. Okay. And that's why lenders like experience. Commercial lending, they like people to have experience in many cases. But like I said, it's a little bit more complicated, a little more trickier, a little bit less lenders. But yes, there are lenders that will lend in this space.
Yeah. Okay. Perfect. Okay, that makes sense. Thank you, Gareth. So we've had a question. We've had a question here. How much does this all cost? Which is a fair question, actually. And I suppose, yeah. All right. So there's a question there. I don't know if you can see that, but we'll get back to that. So yeah, the question I had was, how much does this all cost? I suppose the question there, if I understand it correctly, is I suppose setup. And then just to follow on from that as well, what minimum contribution would you be looking to put into a pension fund every year?
Yeah, so in terms of costs, if you look at SIPPs, SIPPs are generally low cost because they set up through a provider and they charge a set fee on that. And so there's not much that cost wise that goes into there. It just is then getting a provider if you do a loan, or someone that will lend to you if you do a loan back and buy or not a loan, but if you want to buy purchase property using funds from that SIPP, and then need to do a mortgage or something on it. In terms of a SASS, it's more expensive because it's basically seen as a trust, or managed as a trust. So you have trustees and you have fees of setting it up. So they say generally it's £1,000 to £2,000 to set up the SASS correctly, register with HMRC and do the process. So yeah, you're probably looking at about £2,000 to set it up. And then it's just, any management fees that there are from there onwards if you do any changes. But it's not, that's the main upfront thing. And then, the benefit from it is what you need. And then obviously, depending on if you're doing anything specific or needed advice on it, then there'd be kind of tax structuring advice that would come into it. But it wouldn't be too much more on the tax planning side of it. It's more just the setup that would be your main cost generally.
Yeah, perfect. And then no sort of, you wouldn't want to have a minimum contribution. Obviously, there's, the tax liability aside, tax efficiency to one side. You wouldn't really, be seeking to put, it's not an ISA, is it? You don't need to put in 10 grand or whatever an ISA is nowadays, every year.
Yes.
It
no,
is just whatever.
Yeah, you don't need to put a minimum contribution in. It's up to you, but obviously the more you have, because it's 50% of the value essentially. So the bigger it is, the more you can then, use it or loan against it. So that's what it comes down to. If it's very small, it's not going to have the benefit. But if you're just generally doing it in, let's say your company profits every year are just above that £50,000, but you want it to be below, so you can use the 19% tax bracket. You contribute that extra amount every year into a SIPP or SASS, and then that will bring your taxes down and you'll pay less tax on it. So it just depends on your situation.
For sure. Cool. Gareth has asked, how guys, is a 6-bed plus HMO classed as a commercial property which could be purchased using a SIPP or a SASS? I'll take this one. Short answer is it's unlikely. I think what one needs to think about from a property perspective versus a pension perspective is a commercial valuation, which is sort of, I'm guessing what Gareth's alluding to here, doesn't necessarily mean it's a commercial property. So that's just a point of clarity. I mean, we get, from the stuff we do in the social housing space, we get commercial valuations, but that doesn't deem them in terms of a SIPP and SASS structure as a commercial property. I mean, Graham, correct me if I'm wrong here, they are pretty clear and pretty brutal on, what is commercial and what is not commercial. It is literally like the textbook definition. We've tried to go into that gray area, not to do anything dodgy, but simply just, it just, the trustees they won't look at it.
General rental, even if it's more than one occupant, it's long-term kind of rentals or not just, so like, I see that question that popped up around hotels. Hotels can be seen as commercial property, but rentals, if someone's there, year-long contracts or 6 months, it's rental. So then it would be, residential property.
Yeah. So that's the answer, Dom. C2, so hotel, old people's home, C2. So C2, Graham, I'm sure you know this, but C2 is just planning class. But old people's home, hotel definitely, but
it's a special use, so there is special care involved in it. So if it's not just, an old people's residential estate that doesn't have anything attached to it, but if it's old people's, let's say an old age home that's providing services or care and food and things like that, then it's a special class and can be seen as a commercial operation.
Yeah. Dom, so on a FRR lease commercial, yes. The likelihood is yes, but it's always going to depend on the end user. Always depend on the user. If there's AST involved, any sort of leasing, yeah. Okay, perfect. Thank you so much. Okay, cool. I think I'm just checking here. Okay, we've answered that. We've answered the immigration. Can a non-citizen open a SIPP or a SASS? That's just me asking because that's how my brain works. And I'm like, hang on, I've got quite a few siblings that are not in this country. Probably not.
I don't know how it would be classified. I'm sorry, I'm trying to think of it now, because you're allowed to have foreign pensions. You don't necessarily have to be a citizen to have it, but I'm not sure what the regulation is in the UK and whether they would allow it. Sorry,
no, that's fine. That's fine. I mean, it just occurred to me. Okay, Gareth's asking, can loaning from a SASS be used to purchase a resident, to refurb a resident? That's a good question. If you can see the chat there. can loaning from a SASS be used to refurb a residential property as opposed to purchase the property?
So it comes down to whether that residential properties are then going to be seen as a business, because then it's business use or not. So it's unlikely if it's because it's got to be commercial property based.
Okay.
It's a tough one, because residential property, if you've got 6 or 8 properties or whatever, you're running it as a business, but it's not necessarily seen as a business. As HMRC, they see it as a passive income stream. So it depends on how you're doing it.
Okay.
So it's a bit of a one that's a bit more complex, would probably take a bit of looking into it.
And it's unlikely. And to be fair, it's probably not worth it financially, right? Just because the costs involved, why am I off the mark there?
Yeah. Yeah,
I mean,
I'm just trying to think off the top of my head.
Like a residential property, 20
yes.
grand refurb, let's say, that sort of level. Maybe if it's £1 million refurb, different scenario, might be worth going through the aggro. But I'm talking 20, 30, 40, 50 grand refurb. Is it even worth going through all that aggro? Never mind admin overhead, but just sort of.
Probably, those costs might outweigh the saving on doing it if you can get, alternative funding.
Yeah, fair enough. Okay, cool. Well, look, if there's no more questions from anyone, I think we've wrapped up all the questions I had sent in. So I think we'll give 2 seconds just in case anybody's got any other questions. I don't think so. And I suppose the main thing here is this is something that we've only stepped into more recently, this whole SIPP and SASS world. And I suppose, certainly from my perspective, the one key thing is just like get it set up, right? Get it going, get it started. Because by the time you think, I could have saved so much money, that opportunity has passed, really. So the main thing is like, let's get it going, let's get it set up. Yes, there's a fee attached, of course, but it's not extravagant, and as soon as you're starting to invest in property, it's not just about how the funds going in, it's also the funds going out, as you've explained. Correct, so, I would recommend that everyone, either here on the call or who's going to be watching the recording, have a little bit more of a look through this, book a call with Graham, with the team, have the conversation and just see if it's right for you right now. And even if it's not right now, it may be, you might only be a year or two away from it being a sensible next step. So Graham, nice and short and sweet.
Can I say one more thing, Justin?
Yeah, sorry. Go for it.
Sorry, I was just mentioning on SIPPs and SASS, I mentioned a lot on the company side of it, and if you're kind of owning your own company and then making direct contributions from that company to that SIPP or SASS, what the advantage of it is. The other side of it is if you are, just a standard employee and you work for someone else and they are contributing to a SASS SIPP at a certain percentage and you're contributing for a workplace pension, or if you have a private pension or private SIPP with that. So if you do have a private SIPP with them or yourself, you add a portion to it, and HMRC or the government do also add to that SIPP. So they generally add 25% onto it. So if you contribute, £40,000, the additional 15 comes from the government, and they add that to your fund. So you are also getting those funds from the government, which some people don't realize, for free technically on your thing. It's obviously down the line, it's possibly taxed, but it is money that you're getting additional added to your pensions on a yearly basis you contribute, as well as getting a bit of a tax advantage on increasing your tax brackets.
That's a very, very, very good point. So that's somebody PAY employee. What about directors?
So directors too. So they would have the option. If they're director of their own company, they could do direct company contributions. Then the 25% bonus or addition doesn't apply on a direct company contribution. But if they're taking it out, as a director of a different company, not their own company, so they're not a shareholder, they could take it out as PAYE income or salary income still, even if it's director's fees, and then they would be able to contribute to a SIPP from there and get that 25% additional.
Oh, I could go down the rabbit hole on this, yeah. Because I'm just thinking, then you got to balance sort of how how much you're taking out, dividends, tax, and that whole thing. That's the whole thing. See, professional advice always.
That's what we do, and then we come up with trying to work out what's the most effective tax rate.
Right?
Yes.
Yeah, exactly. Okay, that's awesome. Yeah, that's really, really cool. And yeah, I can see. I know exactly what's going to happen off the back of this. There's a couple clients that I'm thinking of that I know aren't here because they're on holiday. They're going to watch this, and I'm going to start getting bombarded with emails. What about this? Could we do this? Just speak to Graham, guys. Speak to Graham. Speak to Graham. Speak to Graham.
Sounds
I'm not
great.
the tax expert. You guys are. You're the pension and tax expert. So, look, thank you very much for your time. I really appreciate it for taking time out of your diary this evening. And yes, anybody who you want to stick your QR code up and your contacts quickly, if they're
Sure.
still easily accessible.
Yeah.
Just as a last shout, if anybody wants to get in touch with Graham, please do drop Graham a message. And yeah, we will. Are we there? Sorry, I put you on the spot there.
No, it's fine. It's just reopening.
There we go. There we go.
we
So
go.
if anybody needs it, those are his details. Take a screenshot or obviously just scan the QR code to book the call. So thank you, everyone. Thank you for attending. Thank you for those that will be watching on the recording. Graham, thank you so much.
Thanks for having us.
Shelley, yeah, we will be chatting soon anyway. So yeah, we'll speak soon. All right. Cheers, everyone. Thanks so much for your time.
Cheers.
Bye.